Well, hello there, YouTubers. I'm a minute late. I am still pulling some things together for you guys, but we are about to knock this thing out because I'm excited to be here with you all. Hold on one sec. I'm going to get a few things together and allow some folks to join, and then we're going to go from there. So just hold tight. Well, happy 2025. I hope you guys are having a amazing year so far. It's a little crazy. I know the fires in California and all those things happening, but other than that, things are ticking right along. We are moving into the year. Tax season's kicking off, so there's a lot of updates that I want to talk to you all about. Mainly being about surrounding the IRS updates for 2020 for tax. So that we're in 2025, but this upcoming tax season is going to be filing for 2024 tax season, right? So you're going to start getting your documents in the mail. If you're a business owner or have a side gig, I'm going to talk about a few things that you need to start getting together. And I know a lot of times people want to know what they need to gather to start to send over to their tax professionals and all of those things. So I'll talk about that. I also have a ebook that I can offer to you all too. If you would like, just message, just put it in the chat that you're interested in that and we'll get it over to you. But we're going to go ahead and get started. All right. So you guys know I'm Katrina the advisor, also AKA Katrina Martin. I'm an enrolled agent and certified tax advisor. I've been in this industry for well over 20 years and specialize in all things tax and business. So what I want to talk about mainly today, I'm going to share some screens because I am a visual person. So I always like to make sure that I have some kind of visuals for you guys. So hold on, I'm uploading a document that I put together for you all this weekend. Now, there are some changes that are happening in Congress right now, as far as for 20 that's full in relation to that's going to impact some of the 2024 filing. So those are things to keep in mind because we're going to need to keep these those are things to keep in mind because there's some things that may change even after if you file early. There's some things that might change after the fact, right? Or change in the process of us doing this tax season. But that's not unusual. That's been happening a lot lately, especially since COVID. There's been changes all along. But what I do want to talk about is I'm going to share my screen here. I'm going to add this to the stage. Just a second there. Let's see which one looks better. There we go. All right. So I want to make sure that you see it though. So let's go that way. I'll make me smaller and that bigger. All right. So 2025 tax survival. Master the game with 2024 tax updates and strategies live. I'm going to be sharing some things that are in my slide deck and also some things that are on the IRS's website as well, because it's going to be really, really important that you understand all the changes that are in progress and happening. So I'm going to go ahead and get started. So let me show you what we're going to talk about today. So we're going to talk about some general tax updates, some family tax benefits that are going to be shifting for you all, some self-employed and some small business highlights, some administrative and compliance updates that's IRS related, and then just some takeaways. So one of the key things that changed this year was the tax brackets adjusted. They accounted for inflation, but it worked in your favor this year. So you'll see in 2023, the amount of income that you had was taxed at a higher amount. So you were taxed at 10% at $11,000. So we have what's called a progressive tax system. So you don't get taxed all in one lump sum, right? So when people say they're being taxed at 37% or 24%, that's not all of your income being taxed at that amount. It's being it's being taxed in these levels. So the $11,000, the first $11,000 is taxed here, 12% is taxed above that. But this is for 2023. But as you look over to 2024, you'll see that 10% is at $11,600. So That's up. So if you're made less than this, then that means zero tax, right? So if you're under this amount, zero tax. So we'll talk about what that looks like as well. So once you get above that amount, right, this is a single filer. Now, if you're married filing jointly, you're not taxed until this amount, 23,200. Do you still need to file? Yes, you probably still want to file, especially if you've had taxes withheld, because you may get that back as a refund, right? So lower taxes, and then this means that your income is shielded, and it's going to reduce your overall tax liability, right? So as you start to go up at 12%, it used to be 11,000. Now it's 11,600, right? So if you're below this, you're taxed at the 10% level, right? So just showing these numbers, how before this was at 22%, it was 44,000. Now it's 22% at 47,000. So if you're at 44,000 now, you're still taxed at this 12% level, right? So just showing how those numbers work, this marginal tax bracket's adjusted in your favor. So this could mean a lower tax rate for you, which means a lesser tax liability for you as well. So that is really, really important. And also the standard deduction levels went up. I always like to explain standard deduction. A lot of people, you hear this all the time. You can either do standard deduction or itemized. What that means is standard deduction. This means, so if you're a single individual, so in 2023, if you made $13,850, this was basically tax-free income, right? Unless, right? So you still would file on it, right? Because you still need to file, but you probably typically at this level, you won't owe a tax, right? That number went up, right? So now if you're a single individual, it's $14,600 is your standard deduction. Married filing joint went up also to $29,200 from $27,700. Head of household status went up from $20,000 to $21,900, right? So this means more of your income is shielded from being taxed, which means a lesser tax or no tax at all, right? So if you're making under these amounts of money, you don't have a tax liability, right? But you may want to file, like I said, if you've had any money withheld, you could probably get that back as a refund, right? So if you made under 14,600 and you're a single individual, or if you made under 29,200 and you're married filing joint, your standard deduction, that means this is the amount of your income that is tax-free, right? So family tax benefits, let's talk about this, because this is big right now, because there's actually some pendings in the Senate right now talking about these things right now. So we won't know for a few weeks, maybe some days, probably a few weeks, what changes are going to happen. But a lot of the family tax benefits are being held up. Well, I won't say held up, but they're being impacted by this ruling that's in place. So let me share that with what that looks like with you just a second. I want to share, where is it? The Tax Relief for American Families Act right here. So this is actually what's in Congress right now. The Tax Relief for American Families and Workers Act of 2024. So they're talking about tax relief for working families, American innovation and growth, increasing global competitiveness. So how this is going to impact you, they're talking about what the child tax credit looks like. They're talking about how much of that is going to be refundable. They're making adjustments for inflation. And they're also changing some rules for earned income credit. So if you qualify for the earned income credit, some of those things are being changed as well in your favor. If these things go through, this is going to benefit you. There's quite a few things the other one big thing too is the extension of the bonus depreciation. We'll talk about that in a little bit as well. So hopefully this really goes through, because bonus depreciation wrapped up this year, if you didn't know. So hopefully this act will go through. We'll see what that looks like. But that's one of the things that's in the works, right? So I'll go back to this document. So as you know, the child tax credit has been $2,000 credit for the last several years. If you have a kid under 17 years old, and your income meets the requirement limits, you can qualify for up to $2,000 of child tax credit. Now, that goes away the year your child turns 17, not the year after. The year they turn 17, that child tax credit goes away. But as long as they're under 17 and you meet the income requirements, you qualify for the child tax credit. There's something I want to talk about too. So this credit is slightly different. And I think the best way to show you what that looks like, I'm going to show you this form. I'm going to show you the tax form that you typically see when you file your taxes. But I want to show you, I think this is a good way to, oh, they don't have the 2024 form ready yet. So we're going to look at the 2023. Let's see. Oh, here it is. I found it. All right. So let me share this here. Just a second. I'll show you the 1040 right here. All right. So here's your 1040 for 2024. So this is what your tax return will look like. It has your information up here, your spouse's information if married, your home address, the filing status that you're going to have. If you had any digital currency, Bitcoin's going to be big this year. So if you had any digital currency, you're going to need to wait for those forms. Or if you've made any exchanges you've made any exchanges where you've pulled some money out, you're going to need to note that on your tax return. This talks about the standard deduction. Can anybody claim you as a dependent? And then here's your dependent information. And then we get into the income section, right? So this is where all the income goes. And this is where we figure out how much you're going to be taxed on. This is going to be figured out what your taxable income is, right? And then on the next page, we go into, okay, based upon that income, what is your tax, right? Because we know based upon your filing status, your income, this is what the tax liability would be, right? So at this point, we know all of your filing status, we know all of your income combined because it goes in here. And then we figure out how much of that income is taxable. And then based upon what's taxable in your filing status, what that tax liability is. And then you'll see right here, this is the tax and credit section, right? So you see right here on line 19, let me zoom in a little bit. Line 19 talks about child tax credit or credit for other dependents. So the child tax credit goes right here. So let's say you got one dependent that qualifies, that's $2,000. Let's say your tax liability up here is $10,000. Then we get this $2,000 credit here. And then if there's nothing else up in here, your total tax would be $8,000 because that credit gets subtracted off of your tax. So your total tax would be $8,000. And then here we go down here. This is the payment section. So this shows what has already been withheld from your W-2. So this is what, if you've got a job and they're pulling taxes out, this is the federal portion. This will be in box 2 on your W-2. This would show how much has already been withheld from your wages. And then if you're a 1099, a lot of 1099s don't withhold wages because you're considered self-employed. But and just in case you've had some taxes withheld, that would be in this box right here. And then any other forms of prepayments that you made, if you made any estimated payments here. So all of those payments that you've done get added up here. Now you'll see here on line 27, this is the earned income tax credit. So they look to see how much you've earned, how many dependents you have, if you qualify, and if so, what that credit is, because this is a refund. Anything in this section is considered a refund. Anything up here is just to lower your tax, right? So anything in the payment section is going to bring the actual money in your pocket, right? Possibly is actually credit, it's a payment back to you, right? And so depending on what's on line 24, because this is what your total tax is, right? So these are the prepayments that you've made. So this is from your W-2, your 1099, any other prepayments you made, estimated payments you made. And then this is a credit. So this is the earned income credit. It's down here because not only is it a credit, but it's a refundable credit. It's money that you can actually be paid out. And then you'll notice right here on line 28, it says just additional child tax credit. So depending on whether you use all the child tax credit up here or qualified to use all of it up here, there's a portion of that if you didn't need it for up here, if your tax up here was 0, you didn't, and you qualify for the child tax credit, that credit wouldn't be needed up here. It would be needed down here. You can actually get it back as an actual payment, right? So this additional child tax credit is right here. And then American Opportunity Credit. This is if you attended school, paid tuition, and it was a qualified tuition. You got a 1098T form in the mail, and you actually had out-of-pocket costs or loans. That's out-of-pocket costs as well. And then that would live here, right? So then these payments would total out. If the payments are greater than the tax, then you got a refund coming. If the tax is greater than the payments, then you owe, right? So that's how that works. That's basically tax 101. So that's where that goes into play. So that's where that child tax credit comes in. That's where that earned income credit comes in, and all of the other credits and deductions that you can qualify for in that payment section, right? So this is what Congress is talking about right now, what that earned income credit's going to look like for 2024, and also what is that child tax credit going to look like for 2024 and 2025. So that's what's happening with that right now. Now, moving on to retirement accounts. Oh, I did want to show you one other thing. Let me present that right quick. Hold on one sec. This earned income credit thing right here. I wanted to show you. Do I want to show you that? Because I just kind of talked about it, but I don't think it can hurt. Here it is. So this is what the earned income limits look like for 2024, right? So it works by your AGI, your adjusted gross income, right? So basically an investment in credits for 2024. So if you're filing a single head of household, married filing separately, or widow, these are your numbers. If you're filing married filing jointly, these are your numbers. So if you make, this is basically showing what your income limits are, right? So if you have children, the number of children or relatives that you're claiming as dependent. So if you have 0 children, you're filing single, head of household, married filing separately, you can make up to $18,591 and qualify for the earned income credit. If you're married filing joint, you can make up to $25,511 and qualify for this credit. If you have 1 dependent, you can make up to this amount as a single person, this amount as a married person. 2 dependents, this amount as a single person, this amount as a married person. 3 dependents, this amount as a single person, this amount as a married person. If you're above these amounts, you don't qualify for this credit. If you're above these amounts as a single or head of household, you don't qualify for these credits. And this credit is based upon a sliding scale. The closer you get to this number, the further you get away from this maximum amount of credit, right? So there's a sweet spot kind of in the middle. So if you have investment income, so let's say you've got some stocks and things that you've exchanged, and you've got it has to be below $11,600 or you don't qualify for this credit. Okay. And the maximum amount you can receive if you don't have any children and you fit into this criteria up here for 0, you can qualify for up to $632 earned income credit. If you have 1 child and you fit into the limits, you can qualify up to $4213. Let me say this again. If you made up to this amount, this 56,004, even if you made 52,000, you're not going to get this 4213. You're so close to the limit that it's going to start phasing out, and that number is going to start reducing. About the sweet spot for this is probably about 30,000, right? 35,000 to get this amount of money. If you get up to this amount, you're not going to qualify for this anymore, right? But the goal is to make more money, so you can, this credit is to kind of even out the playing field, when for lower income, right? Middle class and lower income, because it wants to even out the playing field. You've had so much money going out, you're working. This is called the earned income credit because you're actually earning income. They're giving you a credit for that, right? So this is why these income limits are in place for that. So if you have 2 kids, you can qualify up to $69,660. If you have 3 kids or more, you qualify for up to $78.30. But remember, within these income limits, and that's how the earned income credit works. It's a criteria. It's for based upon you working. If you fit into these income limits and you have this number of qualifying dependents or none, then you can qualify for this credit. And it's a really, really nice credit because it's totally refundable. This is money back in your pocket, right? Or if you have a tax liability, you can lower your tax. But typically, if you meet these income requirements, typically you're not going to have a huge tax liability. So then it would be money back into your pockets. So that part is part 1 on the earned income credit. And then I also wanted to share with you a little bit about the retirement account updates. This has been like really major and really a huge benefit to individuals, right? So if typically, if you're under age 59 and a half and you pull out money out of your 401k, let's say, you're going to pay a penalty on it. If you pull money out of your IRA and if you're under 59 and a half, you're going to pay a penalty on it. Because you're not at the requirement at the retirement age to pull that money out, right? So they typically charge you a penalty. But for 2024's tax filing season, if you can pull out $1,000 per year for emergency expenses and have a penalty-free withdrawal. Now, will you pay taxes on the income? Yes, it's income. You're going to pay on the income, but you're not going to pay the penalty on top of that. Typically, there's a 10% penalty on top of that. You're not going to have to pay that with this new rule in place, right? There's also victims of domestic abuse withdrawal penalty free. So if you're found out, if you're a victim of domestic abuse, you can pull out up to $10,000 or 50% of the account balance penalty free. This is major. They've never had this before, right? So you don't have to be any age. If you're a victim of domestic abuse, you can pull out $10,000 or 50% of your account balance. So that's your 401k, any retirement accounts that you have, right? This is another big one. If you're diagnosed with a terminal illness, you have unlimited penalty-free withdrawals. That is like chef's kiss, right? Because that's when you need it most, right? If you got some medical crisis happening, then you're going to need access to your capital and not having to be worried about, when you get well, that you're going to have these penalties that you're going to have to deal with, or your family's going to have penalties you got to deal with. This puts some ease of mind and gives you access to your capital when you need it most, right? And then also federally declared disasters, right? They took this out. This was a rule that they had before, but in 2021, January 26th, they took it out. But they put this back in. So if you're in an area that's declared a federally declared disaster area, and we're going to have a lot of those in this year, right? You can pull out up to $22,000 of your out of your retirement account penalty free. And there's also a ruling as far as qualified public safety employees like police officers, firefighters, things of that nature. They're expanding the exceptions for early withdrawals there as well, because they understand that, there's things that you need to do, and sometimes you need to have access to your retirement accounts without the fear of having these penalties that you're going to have to deal with after the fact. So this gives you easier access to your retirement savings during emergencies and disasters without added penalty. So this puts more money back into your pocket and gives you access to your capital, right? So now you will have, if you pull this money out, you will have to pay the tax on the income portion of it, but you will not have that penalty that was typically associated with it. So that is like major. I wanted to show you that in another form as well. Just a second. Let me pull that up. Where is that at? Right here. No, not that one. Stop sharing, not that one. I wanted to go to this one. I got so many slides open, guys. I'm trying to make sure that I share everything with you guys and give it to you in a way that is going to be easy to understand and make sense for you. Hold on one sec. I do want to show you this one thing. Here we go. So here is the IRS exceptions to the tax on early withdrawals, right? So most of the things that you want to know are on irs.gov, right? So they have this whole thing here that's showing these are the things that are not going to be, these are the exceptions to the 10% additional tax. This is the penalty, right? So you'll see here, based upon what the action is, what's the exception, what's the distribution, is it subject to the 10% additional tax or no? And then what type of plans it could be. If it's a 401k, is it an IRA? Is it a SEP? Is it a simple plan? And what IRS code it relates to? Because all of these things, remember, IRS is a legal book, all of it. So it all goes back to an IRS code. So this shows you where you can find that information. So you'll see that here we'll see that disability, you qualify to pull that money out. As you go down for education, you can't pull out of your 401k, but you can pull out of your IRA or SEP or simple plans, right? For emergency personal expense, remember you can pull out $1,000 from any plan at this point now. This was made in effect as of December in 2024. So after 12/31/2023, this went into effect. Equal payments. Oh, there was one other thing. Oh, home buyers. Qualified first-time home buyers up to $10,000 pull out. So you can't do it in your 401k, but you can do it in your IRA, right? Military, certain distributions, qualified for reservists. Let's see what I wanted to find some. Oh, here's the terminal illness. You can pull out of your 401k, not applicable to your IRA. And if you also, there was another one that I wanted to show you. The home buyers was big. The emergency savings account was big. Education was big. Personal expenses major. Oh, here's the domestic abuse. So domestic abuse victims distribution to a victim of domestic abuse by a spouse or domestic partner up to lesser of 10,000 or 50% of account. Yes for 401k and yes for IRAs, right? So this is really good because this allows you, also birth and adoption. You can pull out up to $5,000 per child for qualified birth or adoption expenses. That is major, that you can do that in your 401k or your IRAs. So this is basically a chart showing you all of these things listed have exceptions to the 10% additional tax penalty. Major stuff. This is breaking news. So let me see. So that's really big on the retirement account section. And then there's a big increase in the retirement. Well, I won't say big. That's kind of a reach, but there's an increase in the contribution limits for your accounts this year. So let's show you what that looks like. And I do want you to, and I implore you to try to hit these limits. If you're bringing in the money to do so, try to hit these limits, because this is money going to you that is being saved away. And this is going to be one big thing that lowers your taxes, right? A lot of times people are always coming to our firm for tax planning and finding ways to save money. This is always top. This is always at the top of the list of things to put in place, is maxing out your retirement contributions, because it does so many things. And one of the things I'll talk about that it allows you to do, depending on where you invest your money, you could self-direct it into another vehicle that can bring you additional money, right? So say, for example, you take your IRA or your 401k and you roll it over and you put it into a self-directed account where you control where the money goes, where you kind of control how the money is invested, instead of having it a account that's directed by the company, say for Fidelity or something along those lines, right? I'm with Fidelity, I love them, but self-directed is really cool because it allows you to put your retirement income into places that you would like to have them go. So let's say, for example, you want to invest in real estate, but you're not trying to hit your own personal account. Maybe you can't afford to, but you got enough money put into that retirement account that you can self-direct that account, and that account can actually buy a property. So then that account owns the real estate, right? So that money that's growing in your account, it's also growing in the real estate space, right? So you're building capital there. So when you do retire, you not only have all this excess, you have these extra vehicles of income streams to make sure that you're good, right? That's our biggest thing, is we're locking the money away for retirement. So when you do retire, that you're not worried about money running out of money when you're not up for working like that anymore, right? So they did up the contribution limit. So if you can up how much you're putting in there, please do so, right? So for 401k, the employee contribution piece for 2023, it was $22,500 was the limit that you can put in. It went up by $500. Now you can put $23,000 in, right? Now this section here, the catch-up contribution. So once you're over age 50, they know that retirement is nearing. So they want to make sure that if you didn't put money in when you were younger, most don't, right? If you didn't put money in when you were younger, they're going to give you a time to catch up. So on top of this $23,000 that you can put in, if you're over 50, you can put another $7,500 in, right? So that's putting $30,500 into your retirement account. And it's growing and it's growing and growing. So you're putting that in, and then that's your contribution, right? So your 401k total contribution at 50, this is really, really important, because your employer can contribute, you can contribute. And if you're your own boss, let's say you're an S Corp, You're your own employer. So your company can contribute on your behalf, and then you can contribute on your behalf up to $69,000. But you got to be paying yourself enough, and your company has to be earning enough. But if you can reach these limits, please reach these limits, right? And then I'll show you here, traditional IRA contribution went up another $500 in 2023. It was $6,500. Now you can contribute up to $7,000. So that's a $500 increase. The other big one is the Roth, right? So $6,500 was the limit last year. Now it's $7,000. Why the Roth is so important and why you hear it talked about so much, many of you know, but I'm just going to say it for the people that aren't familiar with it. The Roth is cool because you don't get a tax deduction on it. So let's say you contribute to a traditional IRA. Now, if you let's say you did like a traditional IRA contribution of $7,000, you'll get a tax deduction on that, right? Because you'll be able to say, I contributed $7,000. So they'll give you it's not dollar for dollar. A lot of times people are like, oh, I'm getting a $7,000 deduction. It doesn't equal out like that, but you will get a deduction for it, right? So it will help to lower your tax. With the Roth, you don't get a deduction for it. When you contribute to a Roth, there's no tax deduction on your behalf. But the benefit of it is that money grows tax free, right? Because you never took a credit on it. So when you put into the Roth, it grows tax free. So all the money, so let's say you're putting in $7,000 a year over the 20 years, that money has just been sitting there growing. Even if you've been pulling out or you're self-directing it into something else, that money's growing, and it's tax free. That's why so many people are doing the backdoor Roth, because the Roth has income limits. If you make too much money, if you make a certain amount of money, I won't say there's too much money, there's no such thing. But if you make a certain amount of money, you can't technically contribute to a Roth. So that's where a lot of people go do the backdoor Roth, where they'll invest it in the 401k and then turn around and flip it to a Roth, right? Or invest in a traditional and then flip it to a Roth. That's called the backdoor Roth. So a lot of people do that because they can't go in the front door to a Roth because they don't meet the requirements. So if you meet the requirements to contribute to a Roth, put it on your books to do so. If you have so much every month go into that to go towards that, here's I'm going to tell you one of my secrets. So something I've done over the years, because saving is hard, because it's like, oh, I could do this and I could do this. And you're thinking about the immediate things in front of you at the time. But if you just set it on auto, $20 a day that goes into that account, you're not going to miss it as lunch, right? Or if you set it for $50 a week, you're not going to miss it. Just have it go auto. And if you think about, even if you're going to the market, sometimes they're like, do you want to up it for a donation? Yeah, up it for a donation for you. Put that money into that account, and then you can do charitable donations because you got the money to do so. Charity starts at home. And I'm a big fan of paying it forward and all of those things. But you gotta, what do they say on the flight? Put your mask on first. You can't help anybody if you can't breathe. So save yourself first and start putting this money into these vehicles and maxing these out. Most of these things on here lower your tax liability, and everybody's always looking for tax savings. This is where it starts, right? The Roth is the only one that doesn't lower your tax liability, but it increases your wealth because that money is growing for you tax-free. So those are things to consider. Another thing that I wanted to highlight on here, the HSA contribution. So the HSA is the health savings account. Whenever I bring that up, people always think the FSA, the flex spending account. Two totally different things. The flex spending account is use it or lose it, right? So if you don't use it by the end of the year, you lost that money. HSA does not work like that. HSA, that money sits there whenever you're paying for a medical expense. It's basically it's going into account. It gets you an HSA contribution. So if you put into an HSA, a single person, this year you can put in $41.50, right? For 2024, you can put in $41.50. That's a $300 change over last year. You get a tax deduction on this, right? And any medical cost that you pay for, let's say typically what the companies will do, the HSA companies will do, is give you like a debit card or you send in a reimbursement receipt for them or something along those lines. So anything that you pay for that's medically related, you're going to pay out of this account. Now, if you pay for stuff out of this account that's not medically related, then you got to pay a tax on it, right? But typically, if you're paying for anything medically related, you just want to use this for medical, right? And medical doesn't mean just hospital copays and things like that. Medical mean buying Band-Aids, buying peroxide, right? Those are medical, those are health related items. So any of those things are considered medical. So those are, you're paying out of this account. It's not a use it or lose it. Whatever sits in this account, as is growing over the years at 59 and a half, you can use this as a retirement account. The money doesn't go away. So with the flex spending account, it's use it or lose it. Health savings account, and there's no tax deduction for the flex FSA either. But with the HSA, you get a tax deduction and that money is available to you. And at 59 and a half, if you, whatever's available, that becomes a retirement account, right? At 65, I believe, I have to look it up to confirm because that number shifts all the time. I believe at 65, you can't contribute to it anymore. Max this thing out, because this is another vehicle for you to gather, to build up your wealth. And also with this, the HSA account, this can also be self-directed too. So like I talked about, if you're using your Roth or 401k account to self-direct and buy real estate or buy land or buy business franchises or anything along those lines, you can also do the same thing with the HSA account once it has enough capital in it. Right. And so here's your healthcare FSA contribution. See, there's not a lot. You can do the FSA. I'm not a fan of the FSA. I used to use the FSA, but it's not a real benefit to it. So another biggie that's going to impact a lot of people is the 1099K. 1099Ks are things that you typically get from third parties like PayPal, Venmo, Cash App, all of those things. So if you're taking payments through third-party payment solutions, payment entities like those ones I just mentioned, then typically you haven't gotten a 1099K unless you had over so many transactions, over so many dollar amounts. So they wanted to kind of ease people into the changes that are going to happen. So they changed the thresholds, right? So you're going to get a 1099K in 2024 if you made $5,000 if you were paid $5,000 through any of these payment companies, right? So PayPal, Venmo, typically you'll get this from Airbnb. You'll get this from Shopify, all of those things, right? So you'll get that 1099K if you've earned over $5,000 in income in 2024. But as you notice in 2025, you'll get that 1099K at $2,500. And then moving forward in 2026, it'll be $600. The reason that this is being talked about is because they were talking about making it $600 this year. They were talking about it last year too, but they decided to do a threshold rollout, like in smaller increments, right? So this year is pretty much the same. Next year it'll get cut in half. You'll get it at $2,500 and then at $600 and 1099K. What happens a lot of times when people don't get 1099Ks, they tend to underreport the income, right? And so the IRS is trying to get more eyes on what you're actually bringing in. So they're like telling these payment processors we need you to report these earnings. Well, the payment processors kind of pushed back a little bit and was like, that's a lot of work. We can't just do that overnight. We got to get some time. So this is the time that they need to put the systems in place where they can make sure that they got all the information that they need from the people that they're working with, that they got the information, because they got to have your information to send you to 1099K, more than just your bank account that they're moving it over to, depositing it to. They need your business info to make sure that info matches what the IRS has. It's a process, right? Nothing happens overnight. And so I'm glad that they did put this in place, that they're going to slow roll this out. But you see how fast 2025 had. So just think, this will be here in no time. So just think of it. So keep that in mind. This means that you're going to need to button up your books, right? You're not going to be able to just, I think I made about, and there's nothing to justify that, because here's the thing. When you get that 1099K, the IRS is also going to get it. So your numbers need to match what those numbers say, or be greater than, because maybe that's just one payroll processor, maybe, and most people have multiples, right? So you're going to need to make sure that your numbers are matching those numbers. And the only way you're going to be able to do that is to have your stuff properly documented and accounted for, right? So not only do you want to report the income, you want to report the expenses that you have associated with that. And the only way you're going to be able to do that is track that in real time. You can't, it's hard. A lot of people are scrambling right now. We're getting the calls, right? So a lot of people are scrambling right now because they didn't do the proper bookkeeping last year. So now it's like, I'm seeing this income. I got this thing, but that can't be right. I didn't get that much. Well, because you're spending it as fast as you're making it and not keeping track of it. So trying to go back and recover it and to replicate it, it's difficult. So We do bookkeeping cleanup for clients. So if that's something that a service that you need, feel free to reach out to us. The biggest thing that you want to make sure that you're doing is that you're reporting it accurately, because it's not like there is an honor system in a lot of these instances, like that you're reporting the information. But if you get audited, they want proof. So you do have to have that proof up front to make sure that if you ever audited, that you're ready, right? So I won't beat that dead horse, but this is what the 1099 changes are for your businesses, for receiving those payment from payment processors, right? So that is a big change. And then for real estate updates, vacation rentals, the IRS is scrutinizing rental income reporting a little bit more. It's been getting real sloppy, I can say, on my end too, because I review returns for clients and things like that, and I'm amazed at some of the things I see as well. So I get it, right? So what that means for you, if you're a host or working with doing some short-term rentals or mid-term rentals with your for your business, you want to ensure that all your income is calculated and reported accurately, right? Because we talked about those 1099Ks, and most people that I know that do vacation rentals, they use multiple platforms. They don't just live on Airbnb. Typically, people have it across, VRBO, PeerSpace, and then your own websites. People are setting up their own websites to do bookings as well, because then you cut out that extra middleman cost, right? When you've already built up a location and already built up a guest list that you worked with. So you want to make sure that you're keeping track of all of that information and separating it out from other businesses. That's what I've been finding. A lot of people are commingling like crazy, and commingling means you're putting businesses together and stuff together, or personal stuff together with your business. And it is a red flag central. Do you know that if you have an LLC and you've commingled it with either your personal, or you've commingled it with another business or multiple other businesses, you've removed the protective shield of that limited liability company. Because you pierced the corporate veil. So now everything is open to scrutiny, right? They may not have, say if your one business was being audited, now you've got three businesses that are commingled. Now all three businesses are being audited. So just save yourself from the headache, the additional cost, all of the problems that are associated with that. Make sure that you keep it clean, keep it cute, right? Keep it clean and just stay on top of it, and if that's not your area of genius and you know how to make the money, get somebody else that knows how to count it and manage it, right? So hire professionals. That is the first thing that I think that you need in your business, right? You need somebody to make sure that you're doing things accurately and that you're protecting yourself on the front end and the back end. And the finance piece is typically one that people forego and kind of don't want to deal with it, just want the income from it. But you gotta deal with the back end stuff, and you gotta track your expenses, and you gotta make sure that is a ordinary and a necessary expense for your business, because that's another thing that's being checked on too. Like just writing everything off, and it's like, was that actually a business expense or was that a personal expense, right? And if it was business, if it was personal, how do you make it business, right? Because sometimes they do overlap, but you just need to have that thought process of how you got to validate your own claims, right? And so thinking about how do you do that a lot of times is you're going to want to talk to somebody that understands what it looks like, understands what tax law cases have happened and how they've been treated in the past and how certain things are looked at the IRS level, right? Because you're going to want to make sure that you're not trying to set precedents on anything. You want to toe the line, but you want to make sure that you're not crossing it if you can help it, right? We're not operating in fear. We're operating in validation, right? The other thing is depreciation changes. So a lot of us were thinking that the bonus depreciation was going to get extended out, and it possibly could. Remember, I said there are some things in the works in Congress right now, so it possibly could. But as of today, there's no immediate return of 100% bonus depreciation, right? Hopefully, fingers crossed that it does get put back into effect. But as of right now, that just means that you'll be doing your longer depreciation, your standard depreciation on your items. That bonus depreciation was just taking more of the depreciation up front. whereas the chip standard straight line depreciation is what it's called. You'll just be taking it based upon what that item typically depreciates as. So for a single family residence, depreciation standard is 27 and a half years. For an automobile, it's typically 5 to 7 years. So you'll just be doing those standard depreciations if this doesn't get, the bonus depreciation doesn't get picked back up. But fingers crossed that it does. I loved it as well. Cryptocurrency updates. So there's some new reporting rules. There's stricter requirements for transactions over $10,000. So you're going to need to have documentation. I know a lot of people have had crypto for a long time and have done exchanges. And a lot of times it's in a space where you don't even get any documentation. So there's a lot of people having to go back and rebuild out how much they've actually invested to figure out what their capital gain should really be. So if that's something that you need to do, then that's something that you need to really get on. There's a lot of different websites that are doing it now, helping you do that now, connecting all of the different crypto worlds. My specialty is real estate, right? So connecting all the real estate crypto worlds and making sure that you can actually figure out what your basis is, how much you've invested in, to figure out if you sold it, what your capital gain is. But just know that there's more eyes on anything that was a transaction that was over $10,000. And there's an expansion of the 1099 reporting, because a lot of these companies, I told you, a lot of these companies have not been sending out forms. So you're left to figure out all these things on your own. Well, now there's a bigger draw to make those 1099s a requirement for the exchange companies. So if you're into crypto, this is something that you're going to be mindful of. You're going to want to make sure that you're keeping detailed records, even if the exchange isn't keeping those records. You want to start keeping an Excel spreadsheet of those exchanges that you've made, any income that you've had reported back, because ultimately you're responsible for reporting your income and making sure that it's accurate, right? And making sure it's, because you could be hurting yourself if your basis was greater. So let's say you invested $5,000 into crypto exchange, right? And then let's say you sold something, earned $10,000. You pulled out $10,000, right? So your basis was $5,000. So your capital gain could be $5,000, right? That's the difference between the two. You're going to subtract out how much you invested versus how much you got. So that would be $5,000 gain, right? Well, let's say you've done a lot of drop ins and drop outs, right? Let's say that 5,000 was your initial investment, but let's say you put more money in over time. You got to calculate that too. So let's say over time you invested $15,000, where you pulled out $10,000, then you had a loss. You actually took a $5,000 loss. But if you're not calculating that, then how would you know if you're not getting a form from the company? These are things that you got to keep track of on your own. So you want to make sure that you're tracking all of this stuff, that you're doing it accurately. And this isn't difficult. This is your money. I sent to such and such crypto exchange. I sent Coinbase $3,000 on this date. Sent such and such this dollar on this date. Just keep an Excel run and log on it. And that way you can know what your basis is. And then when you pull money out, I withdrew such and such on this date. And if you can, try to make your withdrawals long-term withdrawals, right? So anything under 12 months is considered short-term. Anything above 12 months is considered long-term. If you're doing these crypto exchanges, try to keep them in there and do the long-term. Short-term draws, so short-term gains are taxed higher than long-term gains. So you want to let it sit a little longer, because it's a stock, it's an exchange, and those typically do better on a long-term basis, right? And also the tax on it, right? So if you're moving stuff one day after a day, you're tax, and you're taxing yourself at a higher rate. If you can let something sit longer in these exchanges, then excellent, because then you deal with the long-term gain, and the tax liability on that is actually better than the short-term gain. Okay. And so there has been a change to the W-9 form. So the W-9 form is what you send to your contractors, your independent contractors, to get their information. So at the end of the year, you can send them their 1099s on what you paid them, right? So let me show you what the changes are on that. Just a second. Where is that W-9? Right here. Just a sec. All right. So I'm thinking you guys can see that. So what they did here differently, it looks the same, right? But what they did differently, they added this LLC classification in here. So here when the person sends this over to you, or when you send this over to somebody, if you're going to be doing freelance for them or independent contract work for them, you'll put the name here, the business name here, and then you're going to pick what type of entity structure, if it's an individual or sole proprietor, if it's a C Corp, if it's an S Corp, if it's a partnership, if it's a trust or an estate. And then down here, LLC. So if you select LLC, they want you to enter here the tax classification. If it's an LLC taxed as a C Corp, if it's an LLC taxed as an S Corp, or is an LLC taxed as a partnership, right? Check the LLC box and the entry space. Enter the appropriate code C, S, or P for the tax classification of the LLC. Unless it's a disregarded entity, should instead check the appropriate box for the tax classification of the owner. So typically a disregarded entity means that you don't have any LLCs or anything in place, and you'll be this right here, right? But if you have an LLC in place, it's going to be this, and you're going to need to put either C, S, or P in here, or C Corp, S Corp, or partnership. And then this is also something new over here. They have this exemption from Foreign Account Tax Compliance Act, the FACTA Act, reporting code. So if you have anything, if you have foreign, this is something that applies to you, you're going to need to fill this in too. These are accounts maintained outside of the United States, right? So those are the differences for that. So that you want to make sure that you keep that in mind. That's something you're going to need to get for all of your independent contractors when they start working for you, because you don't want to start sending it over to people now like, hey, I got to report your income. Fill this out for me. You need to do that at the beginning. People tend to do it fast at the beginning before you pay them for work. Once you pay them, they tend to be a little slower with that. Which way is this hair going? Hold on. All right. So businesses must properly classify vendors and update records to avoid IRS mismatches, because when you send this over, the 1099 over, the IRS is going to match it to that individual, or business, and make sure that they're applying that form to them. So they'll be looking for, they'll be looking for that person to repeat, to send in a matching form in as well. So like I was talking about a little bit ago, every form that you receive, the IRS receives also. So it's basically the honor system. They're just matching up what you send over to what they have. And if it doesn't match, then it gets kicked back, right? Because if you get a W-2, they got a W-2. If you get a 1099, they got a 1099, right? You got whatever form you receive, they've gotten to, right? So it's not like if you don't open it, it doesn't mean that it's not already in circulation. And what also happens is, the people that don't file, if you don't file for a while, doesn't mean that your return didn't get filed, because the IRS will file for you. Right? After a while, they'll just file for you. And here's the sad part about it is they're not giving you any of the credits that you qualified for. They're just filing the income as is. That there's no dependents listed. There's nothing. They're just taking the data and applying that data to whatever that tax liability is. So they will file for you. So you want to make sure that you want to do that on your own, right? Because it's a benefit for it. A lot of times you're getting, you applying credits, you're getting money back. This shows, and you need these things for your lifestyle. If you want to buy properties, if you want to, anything that you want to do, you're going to need to have these documents to make it to do so. They want to, even to file bankruptcy, you need 2 years of tax returns. That's what they're going off of, to verify if your income meets the requirements for that. So this is something that you don't want to push off to the side and procrastinate on. You want to make sure that you're on top of this. So anytime you hire a contractor, have them fill out this W-9 up front, and then that way you keep it in your files. So when you need to report the 1099s, you can go ahead and get that off to them. Okay. BOI, beneficial ownership information reporting. I have a video that I loaded on here on YouTube probably a week ago or so. And I basically did the steps it's on FinCEN, Financials Information Crime Network, or something like that. It's on FinCEN, where you have to actually fill this out. But go to that video if you need help. It was actually due by the end of the year. It was due on December 31st. However, it got caught up and it got appealed in December, and so they delayed it, but now it's back in effect. It's a requirement, and it needs to be done by yesterday, January 13th. So if you haven't done that, do so, because there are some really stiff penalties associated with it, financially and criminally. So you want to make sure that you get that in. There's the only exceptions to this. So typically, if you have a 1099, not a 1099, if you have an LLC, if you have a trust, if you have a nonprofit, you're going to want to do this. Basically, you're reporting who the owner is of that organization, who's responsible for that organization. The reason that's been given is because they want to make sure that it cuts out money laundering, terrorism, and all of that. They need to know who owns all of these organizations. A lot of things came up that, were kind of just out there during the pandemic. All these companies started popping up, these LLCs and all, and they didn't know who the owner was on some of them, right? So this is going to give a log of who those owners are, who to contact. And then anytime you make any changes to your ownership, locations, anything like that, you're going to want to go back and update your records on FinCEN.gov. Right? This is not an IRS mandate. This is with the FinCEN, Financial Crimes Unit. This is not this is what they're going to do with this. They will match it to what the IRS has, but the requirement is not with the IRS. The requirement is with FinCEN. Okay. So make sure you get that. This is another requirement for small businesses. So you're going to want to make sure that you're doing this. If you've paid somebody to do it, then it's an expense that you can write off in your business. If you do it yourself, then it's free. So jump on that today if you haven't, because this is something that you're going to need to have on record, And I'm not sure, how things happen when something starts off. It's like, oh, just do it. And now all of a sudden there's going to be part of a requirement. Like if you're applying for some type of financial support or something like that, it may end up being one of the documents that's a requirement. So just get ahead of it and go ahead and get this in ASAP. Like today, it only takes a few minutes. It's all your information. So it's not something that you got to go searching for. It's your business information, location, your personal information. You'll upload your ID or your passport, whoever the owners is, and pretty much that's it, right? So you'll do it in 3 places. You'll do it for the business, you'll do it for the beneficial owner, and then you'll do it for whoever's filing the paperwork, which typically, if you're the beneficial owner, it'll be you. And then basically you review everything, make sure that it's right, do the validation, and then that's it, right? Download it when you get it, because I was expecting when I finished them in the past, I was expecting an email, and I haven't gotten any email. So make sure when you finish up, download it and save it into your files. Okay. That's all I got for the most part, but I do want to take questions. So if you guys have any questions, put them in the chat. I blocked out time for you all, so definitely let me know if you have any questions. Don't be shy. Any question? There's no stupid question. This is all tax season changes every year. So just like you have to figure out what to do every year, we have to figure out what to do every year because the laws change. I mean, not the basis of it, but actually figuring out what the new laws are and the rules are and all of those things. So my pro tip, I always try to leave you with a pro tip, is work with a professional, preferably a licensed tax professional this tax season, to make sure that you're getting that somebody that's having to do their continuing education and understands tax laws and how to individually work with you. If you need help, feel free to book a chat with me and my team. But I will talk about a couple of questions I've had come up so far. All right, so I'm going to take this down. And here's my info, but I'm going to remove that right now. I'm just going to come on camera. So a couple of questions that I've been receiving is, well, I'll talk about when is the latest date, Travis? When is the latest date someone can give me my 1099 for working? Good question, Travis. So typically they have to be mailed out by January 31st. They have to be postmarked by January 31st. So it needs to have gone through the post office and stamped. The date that is stamped has to say January 31st. So, but there's no requirement on how long it takes to get to you in the mail, right? It just has to be postmarked by January 31st. So typically right after that, within a week of that, you'll have it in the mail. If you don't have it, then you can reach out to them to have it. The IRS did put a lot of new things in place. I didn't talk about, one of the things I wanted to talk about is they have put in place, if somebody has stolen your identity, let me do this. Hold on one second. Let me share this. If somebody stole your identity, you can now check on the IRS website and report it, right? Here it is. What to do if I didn't file a tax return, verify your identity and tax return, other ways to resolve. And then there's also this other item that I wanted to share with you all. So this is basically what to do if I did file a tax return, what to do if I didn't file one. They never had that before. They had, if you were a victim of somebody's identity theft, nobody, just kind of went off into never land. The IRS will handle it on their end, but you would never know what was going on, right? Now they're getting the people involved and helping to do that. And then another thing that they put in place that's actually really good this year, if you get certain letters in the mail, mainly letters that are related to the earned income credit, the EIC credit. Remember, we talked about that. This is the income-based credit. If you get a letter for that in the mail now, before, you would have to do the snail mail process. You'd have to mail in birth certificates to prove the kids were yours. You have to mail in school records to prove they lived with you, and doctor's records and all that kind of stuff. Now you would have to mail it in and just wait. And it takes 12 weeks for them to even say they got it, right? So now they have it where you can actually upload it online. So that is going to save people a lot of headache, because especially if it's an actual parent trying to claim their kids and needs this refund, because heck, it's your money. And so but they don't get they got to wait. Typically, they don't even get a follow-up until summertime, usually, when that happens. And it can take months and months. So this now will eliminate that dragging and taking forever for you to get your refund. And it'll actually upload the documents. You can upload the birth certificates, medical records, school records, and all of that. And then that'll make it really easy for people to overcome all of those hiccups. And then the other thing too is, what was the other thing? Okay, so that was the school. So the verified identity. If you're a victim of identity theft too, go on irs.gov and put in for an identity protection pin. It's called an IP pin. And you can put it on your kids too. So if you've ever if somebody filed you or your kids on their tax returns before, you're going to want to put a pin in place. Or if you got headaches when maybe you're the custodial. This is what I deal with a lot. If you're the custodial parent, you're racing the non-custodial parent to file because you don't know who they're going to claim the kid that they're not in their custody. So a lot of times I recommend in those instances, get the identity protection pin, right? Because that'll alleviate all of that. So you can put it on you and your kid. And then every year you'll get a new pin. It's a 6 or 7 digit code. You'll get a new pin. And you used to have to wait for it to come in the mail. Now you can actually pull it up online. The IRS is coming into the 21st century. You see that? So any other questions, Travis? Yeah, you'll get it after the 31st. So it should be postmarked by the 31st. If you don't get it, what you can do is you can file a substitute version of it yourself. Just file it anyway. You know how much income you received, and when just file it, because it's in their wheelhouse for them to do. But if they're not doing it, it's still your income to report. Can clients send you tax paperwork this month and or next? Absolutely. Yeah. So we have a tax portal. It's a secure client portal. So people are starting to upload as they get things. We know that everything's not there. Most people won't have everything until mid-February. Unless there was just like one business and all you had was a profit and loss, right? But I question that too, because typically you're still getting stuff in the mail. You're usually getting a medical form if you've done the Affordable Care Act. So if you've done the Affordable Care Act, you're going to get what's called the 1095A. A stand for affordable, right? I don't know what it stands for, but that's what I highlighted too, right? So 1095A, you'll get a lot of different medical forms. So there's a 1095B, there's a 1095C. It just depends on where it's coming from, right? So 1095Bs are typically state-funded programs. Cs are usually your employers, right? Employer-funded medical programs. But the A is for those that are in the marketplace. Obamacare is what a lot of people call it, but it's really the Affordable Care Act. And so you get that 1095-8. That's required, that form. So you don't have to, a few years ago, they had it where you had to have medical insurance. They got rid of that. But what they did put into place, if you've got the Affordable Care Act, you have to put that form on there on your tax return. That 1095-A has to go on your tax return or it'll get rejected because since you use the government program, right, it was based upon income. So what it associates with is the premium tax credits, right? So you need to know if that's going to be, they need to see what your income is reporting and see, did you overpay for insurance or did you underpay? So sometimes you can get money back and sometimes you can be, you may owe, right, a little bit towards that. But if you did the Affordable Care Act, you're going to get a 1095-A. So you're going to need that. So just start uploading you can start uploading on our end. You can start uploading documents to our portal. We have an indicator in there when you've gotten everything, that you indicate that you have everything. And what we typically do is we'll look at all the forms, we'll compare it to your prior year return to see what forms you had before. If we see anything missing, a lot of times what I'll see is people may have, a lot of people are getting a pension and they're working, right? So they may have started young and you may be military and then they're getting a pension and but they still got a W-2, or they worked at a company for a long time, still young, and then retired, and so they're getting a pension from there, but they're still working. So a lot of times they'll put their W-2 in, but not that 1099-R, that pension form, right? And so in those instances, I'm like, hey, last year you had a 1099-R, you had 2 of those. We don't see that. Oh, I'm still waiting. Oh, okay, I didn't get that yet. So we can put up reminders based upon what we know you have, and that's why it helps when you have a relationship with your advisor, right? Because then we can see those little nuances that says something's different, right? Like, or I just talked with some potential client this morning, and he was saying that for 2022 taxes, he got a refund. For 2023 taxes, he owed $12,000 to $15,000. I can't remember. $12,000 for the federal and $3,000 for the state was what it was. So, but the prior year he had received a refund. So he's like, did they do something wrong? Is this something I could correct? I don't think our incomes were that different. So I'm like, well, here's a link to the portal. We can review the return and see if there's something off. If there was something off for last year, usually there's always an explanation for it, right? But if there's something wrong, if somebody did something wrong, if this preparer did something wrong, then we'll see that as well, and then we can correct it in an amendment or something along those lines. So so as you start to get the paperwork, if you want to upload it before you lose it, yes, or upload it while it's on top of mind, then yes, we advise clients to upload them, and then we don't start moving until we get everything, because I don't like piecemeal work. I'm going to work on this a little bit, and then I'm going to go back to it. We wait till we get everything, and then that way we can knock it out in one time. What I find is you have errors when you keep going back. I'm a firm believer of measure twice, cut once, right? So we make sure that we have everything, and then we go and move forward with it. So good question. Any other questions? I know it's tax time, and I know our phones and our messages are blowing up, so I know there's questions. So if you don't, and there's not, like I said, the question that you have typically is one that everybody has. The other thing that's come up quite a bit is some people are still waiting on, there's a rule as well that some people didn't get the stimulus check. So I see this big TikTok thing there's stimulus checks. So those are people that didn't get the full amount. So those people, if they didn't get the full amount, they can apply for the stimulus now. So some people got the $1,400, and then I think it was $600, it was $1,200, and then there was a $1,400, and then I think there was another $1,400 or something like that. So if you didn't get the full amount and you did qualify for those, then there's also a recovery period for those right now too. So what else is there that I think that is important for you all? I know with all the fires and things, there's going to be probably for California. Hey, Chris, when is the deadline to do a traditional IRA conversion to Roth IRA? It's really not a deadline, but usually most of the deadline really revolves around the tax filing time. So April 15th is the deadline for individuals. So anything that you're going to want to do before that date, or after, if you file an extension with the extension date. But there's really no deadline for that. But I'm sooner the better. The sooner the better, right? Because you want to make sure that money is growing. If an employer covers your housing, does that have any tax implications? Now, when you say covers your housing, Travis, what do you mean? Do you mean like a pastor? Is it a church home, or how's that? Or are they just providing some? Tell me what you mean on that one, because if there's a church home, then that's one thing. But if they're just providing you some, because is it a W-2 job? Because usually with employers, anything that they're providing, they're including on the W-2. So in that section that says 12 on the W-2, they include everything in there, and there's a code for it for pretty much everything. So if your employer is covering something, then they're going to put a code in there on your W-2 that lets the IRS know that was something that they paid out of pocket, that didn't come from your income, not church, just W-2. Okay. Yep. So it'll be on your W-2. Is it a stipend, like a housing allowance? Yeah, I'm thinking that's what it is. It's probably a housing allowance. Yep, that's it. So it'll be on your W-2. It'll be in that box. Let me see if I can share that. Box 12 of the W-2. Let me show you what that looks like. Let me tell you which code it'll probably be. Hold on one sec. Let me pull this up. All right. Let me share my screen. Share. Okay, so here's box 12. This is when you see those codes on your W-2 in the box 12. So box 12 is a big section. It usually has like 3 or 4 columns in it, but each column has like a different code. So usually you'll see like a D code in there, and that's your elective deferral to your 401k. So that usually shows what you put into your 401k. And then we'll see, but all of these codes, so if you see a code T, that means you got some adoption benefits, right? AA means you designated Roth contribution. So this is just a code these are W-2 box 12 codes. So anytime you see any of these codes, those alphabet in that box 12 on your W-2s, these are what they mean, right? They all have a meaning to them, right? So let's see if there's a housing one in here. Let's Google it. Hold on, find. So I don't see one for housing in here, but that doesn't mean they didn't list it under something else. Yep, substantiated employee business expense reimbursement. So it could be that, but it'll be listed in that box 12 on your W-2, because they're going to get their credit for anything that they can do. A residential schooling institution, absolutely, yeah. So schools typically have just covers as part of the job. Gotcha. Okay, so it's part of your earnings. Okay, so it'll be included on your W-2. Good question. No, that's pretty cool. Residential schooling institution. I like that. So it covers part of the housing. Excellent. That's really good. And I was talking to a client yesterday, and she was talking about she works at a school, I believe. And she put in for her student loan forgiveness. And I think she said she has 6 more months, because I guess you have to do 10 years. So she's got 6 more months, and then 6 more payments, and then she can be forgiven. I'm like, girl, you won the lottery. You have hit the lottery, okay? Because that is major stuff. Any other questions? I'm trying to think of any anybody that I've spoken with recently that I've know that is kind of a trend. I think the biggest thing too is if you have a business, and you haven't done what I hear all the time, and I kind of chuckle because everybody always says when I ask them about their bookkeeping for their business, I'm like, well, I have QuickBooks. And then my next question is, are you using it? And it's usually like, nah, not like that. So So just because you have QuickBooks does not mean you're doing the bookkeeping, right? So if you have a business, even if you're not to the QuickBooks stage, maybe you're just starting out and really starting to get your feet wet, you want to make sure that you at least log what the heck you got going on, because even if you're in the startup phase, right? Because say you just started a business, you haven't launched yet, that doesn't mean that you don't get to take some write-offs, right? So those startup costs, you can amortize those and write some of those off before the business gets going, right? Not all of them, but some of them up to $5,000 you can write off before the business gets going, because you may be doing research. Maybe you're meeting with attorneys or accountants to do the layout in advance, right? To do the planning part of it, right? So if you've got out-of-pocket expenses even before you've got earned your first dollar, those are things you keep track of, because you can write some of that off. Not all of it. Like I said, if you're buying paper and all of that kind of stuff, not so much for that, but like research, legal fees, professional services fees, if you're getting like trademarks and all of those types of things, or paying for, registrations and all LLCs and all of that. Yeah. Yeah. So those are startup costs that you can deduct even before you get going, but you need to make sure that you're documenting it and listing what it is, and that you're keeping track of the stuff. So separate bank account for business. Do not commingle. I've got some clients now where unraveling their QuickBooks accounts because they've got 2, 3, 4 businesses in there. And they don't need to be together. Right. So we'll, and then a lot of what we're doing too is just making sure, because a lot of people are going for funding, what we've seen as a trend, people were doing their best year in business for most businesses. And this is not some scientific thing. I'm just going off of what I'm seeing in the numbers for our clients and talking to my peers. 2022 pandemic, right? 2022 and 2023 were typically the best years for over the last maybe 8 years. 2022 and 2023 were like really good years for businesses. 2024 was kind of a drop, not major, right? Not like you're out of business. For some that was, right? But for most it was a drop. Like you may have not earned at least $50,000 to $100,000. You've earned less than that in 2024 than 2023 or 2022. So what we've started to see is a lot of people revisiting what they're spending on, right? Because when times are good, we're like, make it rain. And then when times get lean, we start to trim down, right? So what I do recommend, a lot of our what a lot of people should really do, this is the perfect time while you're gathering your documents for your business or gathering your documents for you. This is the perfect time to get your budgets together, right? Because now you see what you're spending. And so now this is a good time to say, I'm going to curtail that. I'm cutting these subscriptions out. One of the things that I do is every 3 months I go through my bank statements and start cutting all those subscriptions, because a lot of times you'll start a trial and just forget to cut it off and you're not even using it, right? So just revisiting those things. And usually I'm cutting out like not $10. It's usually a couple $100, when I'm going through it, because things start off low, but then they tend to the price tends to increase after a while, right? And if you're not using it, then why are you just giving, it's not a charity. It's not, don't give them money. You can give away to charity, but not these subscription services, right? So so this is a good time to look at what your spend is, look to see what your actual out-of-pocket costs were, right? Excuse me. And then make sure that you're actually getting you're getting yourself started on the right path at the top of the year. I know we all come up with these resolutions. I'm going to lose weight. I'm going to go to gym. I'm going to go to church. I'm going to do all these things, right? And the one thing that you can definitely guarantee yourself to do is you got to file your taxes. So in doing so, get all your finances together, right? Put a plan together for the year, how you're going to be able to make your investments into your retirement accounts, because you want to do so. And you got to do it for how you move, right? Like I know it's better out of sight, out of mind for me. So I'd rather just put it on auto, right? Because then if I see it 9 times out of 10, I'm I'm going to start thinking about the immediate things. Well, I did say I was going to do such and such. And I said, I do got to get that ticket for this. And I do got to. So I start thinking about things in the immediate, whereas this retirement is for later down the line. This is the long range goal. When we see stuff, we're thinking short range, right? But we got to be thinking long range. So I needed it to be out of sight. So just put it on auto, $20 a day, $50 a week, right? So you can't miss what you didn't count, right? You can't miss it because it's already there and it's already building. And then when you start to think, oh, don't I have some money somewhere? You just go look for it and see that it's growing and leave it alone, right? Because you don't need it in the immediate. Or if you need it in the immediate, it needs to be for a bigger goal. Like if it's for buying into another business or buying into a policy that's going to bring you some cash value, right? Money needs to make money, right? Don't just put money out consuming. Invest. This is the year of investment. That's what we're going to call it, right? So make sure that you're putting some money aside for rainy days or good days, right? Because the inflation is doing what it's doing, and the economy is doing what it's doing, and the world's doing what it's doing. We got a new president coming into place that's going to do what he's going to do, right? So the only thing that you can really control is how you move and how you operate, right? And how you spend. You know you're spending and you're not going to change it overnight, but what you can do is trick yourself into saving. So however you need to trick yourself to save, that's what you need to do, whether you need to put it away, send it off, put it on autopilot, small increments, not enough where you're going to feel the pain. And my VA just put that in there. If you guys, I do have an ebook. Anna just put a link in the chat for you guys to grab that. It's a survival kit for 2025. It's free for you. So just grab that, hit that link and grab that. It'll be really, really helpful to you. It'll give you like a checklist of things to gather for your 2024 filing. Your W-2s, your 1099s, your 1098s, your rental income, your expenses, your profit and loss statements. What does that mean? All those things, right? So it's a checklist of all of those things and things that you're going to need to work with your advisors and all of that. Any last minute questions? I don't want to hold you all day. I did want to give you some updates, some good some opportunity to ask questions, and then just some insight on what's happening in the year. And then I gave you my 2 cents on how you can boss up in 2025, right? Because I mean, you really got to have some savings, right? And the best way, and it doesn't need to be in your bank account unless it's a high yield savings account, right? If your bank is just for moving the money around, right? They're lending it out as you putting it in anyway. So, but what you need to have is some vehicles that are bringing you high yield, it's bringing you some interest, that your money you're in control of it, right? And that the money is making money. And if it's not making money, move it into a space where it does, right? I'll start talking about what that looks like. In the next live, we'll talk about some investment opportunities and ways that you can save, and then how you can build those, how you can max out those retirement accounts for 2024. I think that's what we'll talk about next. So if there's no other questions, I will give you your time back, and thank you for joining me this afternoon. We'll go ahead and edit. We'll probably edit this video or something along those lines and just pull out some highlights and things. But in the meantime, have a fantastic Tuesday, the 14th. Make sure you do your BOI updates if you haven't already. And again, I'm Katrina, the advisor. If this video was helpful to you, please like, follow, and subscribe, and I will catch you on the next live. Have a great day. Bye-bye, everybody. Thank you.